Good afternoon, everybody, and welcome to the market update for June 2024. I'm Cindy Bishop with Cindy Bishop Worldwide and want to introduce Mike Ott to you today. Mike is with First Heritage Mortgage, and Mike is I think he's an exceptional lender. He explains things in great detail, has excellent, thorough explanations. He must have been a wonderful teacher. He is a former public school teacher and has been in the mortgage industry for well over 19 years. With his educational approach and exemplary business reputation, Mike is loved by his clients and agents, which is proven in the fact that most of his business is referrals. Mike comes to us today with the monthly market update, which is very unique in that it's very detailed. We do it later in the month because it has very detailed reports associated with it. So you guys are getting a very detailed accounting of what's going on with rates, mortgages, and the market. Welcome, Mike.
Thank you, Cindy. Good afternoon, everybody. Thanks for joining us. Let's dive right in. We always take a look first at rate range on our various loan programs. And, we've kind of a repeat message after, from last month where we seem to have some settling in rates post-Fed meeting, post-BLS jobs report, which we had another kind of outrageous report. We'll talk about that in a second. And then our CPI inflation data. So for the loan programs, conventional, conforming, we're seeing 6.5%, 7%. And I don't usually kind of dive too deep into that category, but in its subcategories, you have to keep in mind that there are your low to moderate income programs that are kind of at the lower end of this rate range in the 6.5, 7 range, where we've got a lot of programs out there that are tied to 80% area median income for a lot of areas. And essentially what that means is when you've got borrowers that are at or below 80% and they still qualify, they're getting, they're actually given kind of the best of terms. Now, if you're, above 80% area median income, that's usually what you see when you see the published rates, like Freddie Mac does their interest rate tracking. And I always plug that site there at the bottom of this slide, Mortgage News Daily. They're looking at kind of more your standard, and then some of them lump everything together. And that's kind of what I try and do here, is kind of give you this half a point range that we've kind of seen since the last meeting and kind of what we're living in right now, of where rates stand. So you've got, the conventional conforming is kind of a, flexible space. That's where you would also see some of your state bond programs and state grant programs and things of that nature will trend very closely to that conventional conforming. Now, with DC high cost area, we have that second level of conventional high balance. And then if you're not in a high cost area, then it's considered true jumbo. That's been stubbornly stuck kind of in the low to mid sevens. And again, there's a lot more emphasis and assessment of risk based on credit score. When you get into the jumbo, obviously they want more money in down payment. So in that sense, the more you can put, you can get closer to 20% down or do 20% down, you're probably going to be at the lower end of those jumbo rates. Government programs, VA always trends a tiny bit lower in range compared to its government partners there, FHA and USDA. So in VA, we see 6.25, 6.75 is kind of the here and now. And then we're at 6.5, 7 in FHA and USDA. And again, that's very closely aligned with, what we see in that conventional conforming. Mortgage News Daily is the free site that does a pretty good job of tracking national averages across the different loan types. And that's always a great resource. All right. And we always take a look at what mortgage-backed securities are doing. Last month, I kind of did a before and current, and I'm gonna kind of stick with that setup this time around too. I wanted to put up what we had in the slide deck last month, where we saw a low number in BLS jobs, and we had a nice jump up in that green candlestick, and then we got a very favorable CPI number in the middle of May, where we had another good bump up. Now, when I flip to what I pulled from this morning, we have we've had some ups and downs since that time frame. And this time around, and we'll talk specifically on numbers, the BLS jobs report that hurt us. We have a big drop in red candlestick there on the BLS jobs. And then we had a very arguably tame, dovish message from the Fed a couple weeks ago, and we saw mortgage-backed securities really respond well. In fact, in that day, you can see in that Fed meeting green candlestick, that top wick of the candlestick is how high they went that particular day. So during the meeting and during the Fed press conference, mortgage-backed securities, took off to the races, but yet by the close of business that day, after the Fed was done speaking to the public, we kind of had some backtracking. And again, a lot of that is immediate profit taking in the market, perhaps. And now we look fast forward to today. The most recent report was retail sales came in a little soft today, and that's a good thing when we're looking at interest rates, right? Soft retail sales suggests that people aren't spending as much, and that's all clues into a weakening economy. And again, you guys have heard me say this before. It's sometimes it sounds negative when and I feel like I'm trying to, I'm like rooting for bad economic numbers, but that's essentially what it's going to take to force the Fed's hand at lowering their federal funds rate. And I think when they do so, we're going to see mortgage rates will tend to fall up. All right, so what all has happened? Well, since we last met, we did get at the end of May, we got April's PCE, personal consumption and expenditures, and that's the Fed's favorite measure of tracking inflation. We have the PCE and the CPI. The Fed follows very closely PCE. Headline inflation increased 0.3%, which the overall reading remained unchanged at 2.7. And keep in mind that the Fed's all they talk about is getting inflation back down to 2%. And we kind of just stagnated. And what they really pay attention to is that core PCE that strips out volatile food and energy costs. But it was also up 0.3%, remained at 2.8. Right. Now, core inflation, so yes, it's remaining stubborn. It will likely take a weakening economic picture for the Fed to cut. The next PCE will be here, in 10 days from now. All indicators right now are leading us to believe that we would expect to see a softer PCE, or at least kind of remaining unchanged. But the way they calculate and the way they look at this inflation data, and the Fed alluded to this in their meeting last week, that they're expecting inflation to do a little uptick in the coming months. And the reason for that is the way they do kind of their 12-month average look at it. Because what's going to happen is, even if inflation stays in these 2.7, 2.8 range, right? What we're going to have is we're going to be replacing very low inflation month-over-month numbers from 12 months ago. So the data is probably, we have to kind of prepare ourselves mentally that you're going to probably see some headlines in the coming months that are really doom and gloom about inflation may be ticking up a little bit. And the media is probably going to run with that. And they're going to have stories on there about, oh, that's going to be fuel for the Fed to increase rates because inflation is going in the opposite direction. But I think the Fed, believe it or not, I think they're smart enough. They understand the average. He even alluded to that. One of the first questions that was asked by, I think, CNBC at the meeting was about that, because they put in their report that they expect to see inflation up. So the media wants to take that and run and say, well, then wouldn't that be cause for you to increase the federal funds rate? And that's not necessarily the case. And I actually think Jerome Powell did a very good job of addressing that. And they used, he, in his verbiage was that monetary policy right now is restrictive. And what that's code for to the markets is that there's no one on that, there's no one, no voting members think that we're going to increase rates, right? That it is restrictive enough, has been restrictive enough. And again, they're going to kind of stay the course. What is it going to take to see a lowering of the rates? Well, it's going to have to come from a weakening economic picture. ADP reported their job creations at 152,000 when the market expected 175,000. That's going to be in very sharp contrast to the BLS jobs report. But before we get to that, JOLTS jobs opening, they retracted a little bit. They were down. So you've got ADP and JOLTS with not so great jobs number. And then on June 7th, we get yet another blockbuster number of 272,000 jobs versus 185 that we're expecting. Now, we had 1 month where BLS jobs report showed some weakening. And it's one of those things, and I've talked about this, there's a lot of flaws in the modeling of how they get these disconnect between the surveys that they do. But I put in green there, even though that jobs number seemed to kind of blow away the expectations, what the Fed's really looking at is the unemployment rate ticked up from 3.9 to 4. And if you've ever seen their perspective, so kind of their prediction of what they think, all those Fed members do think that we're going to see inflation at 4 and 4.1. A few of them probably think 4.2 by the end of the year. But what's tucked away in all this report, right? The 272 blowing away 185,000, that's what gets the headlines. But what's tucked in there is that full-time job losses were 626,000. And you got to remember, full-time employees are the ones that make the economy move. They're the ones that buy homes and buy cars and boats and et cetera, et cetera. But we're continuing to see full-time job holders lose their jobs. Average weekly earnings was up 0.4% for the month. And at 4 to 4.1, that on the surface again looks inflationary, right? People have more money to spend, well, they're going to spend it, and that cost of goods is going to stay elevated. But we haven't really seen anything too dramatic in that. In fact, you've probably seen we're starting to see, and I've heard it in the news, like your fast food chains, they're bringing back less expensive meal deals and things of that nature. And the reason why they're doing it is because they're at the forefront of the truth. They're seeing that people are not spending the money on things like that, like fast food. So what they're trying to do is obviously incentivize them and offer some of these meal deals. I think you're going to see more of that, because under the hood, we have people that, are arguably spending less, as evidenced by today's retail jobs or retail sales report. All right, so after BLS, which again, that was a bump in the road that didn't help us, but in the background, unemployment went up. Trust me, the Fed is watching that. CPI was just last week. That headline inflation number was up, but it was still below the expectations. And we dropped 0.1%, 3.3 from 3.4. Core was up 0.2 on the month, year over year, 3.4, better than the estimated 3.5. So that CPI number was good for us. The thorn in the side remains to be shelter costs that make up 45.4% of that CPI reading, up 0.4%. And if you've been, on these and attending, that I've talked about, there is a serious lag in the reporting of that data, and it takes months for this stuff to catch up. And we know through other reports that rents have stagnated a little bit, right? They're not escalating, they're plateauing, if anything, and that's eventually going to show and help out this number. The one thing that's part of CPI, which is you've heard me rant about my frustration with it, is the cost of motor vehicle insurance. It makes up 3.7% of the CPI reading, and that was up another 1.8%. Again, not as bad this month as the prior month, but what's frustrating about that is what the Federal Reserve does with interest rates and monetary policy can't touch what insurance companies charge for motor vehicle insurance. And so that's one aspect of inflation in these reports, that the Fed, whether they're raising or lowering rates, has zero impact or control, if you will, over the cost of insurance. But we saw a run up in car prices, used and new. The technology in these only gets better. So when they're lost, stolen, damaged, right, and insurance has to pay for it, well, that's why they're hiking up those premiums, because the cost of the vehicle and the cost of the gadgets and technology that go into them now are so much more expensive. And then we had the Fed meeting last week, no change in rates, rather subdued, kind of arguably dovish comments, and we saw mortgage-backed securities respond pretty positively on that day. Next meeting will be at the end of July. The markets are not expecting a rate cut there. Either all eyes are on the September. They think if we're going to see a first rate cut of this year, that it would be the September meeting. And I would argue that I think we're only going to have a chance of that if we can start seeing some of these employment and jobs numbers come down a bit. And retail sales was for today for May, increased only 0.1, which was below the expectations of 0.2. Right, doesn't seem huge, but trust me, it's a sign. Control group, which strips out autos, gas, and building materials, increased by 0.1, which was lower than 0.3. So if you think about it, that's kind of like a core retail sales, if you will. And we last month I put up this CPI chart, and I got the refresh now. And I love this chart because it shows you the shelter and the motor vehicle insurance and how sticky they've been, but also how big of a slice of the pie, right? So if the core reading was 3.41, well, shelter at 2.45 and motor vehicle insurance at 0.75, I mean, that's a huge chunk, which means everything else in the core reading, all the other goods, is at 0.21. That number alone is proof that the Fed's hiking of the rates over the last, 2 years, it's doing its job. It's just you've got the lag component of shelter it's going to, be tough for us to see the catch up in that. And then the motor vehicle insurance, which again can't really be controlled by what the Fed does. So they remain the thorn in the side of the overall picture. But stay optimistic and hope that smarter minds on the Federal Reserve boards and the voting members are paying attention to this data, because they've squished a lot of the inflation for sure. Right. All right. All right, let's look at local. When I went in and I did this morning, I've been waiting for our local real estate here in the DC area. I look at NVAR, PUR, and DAR. Only Northern Virginia was updated for May numbers. Median price 760,000. That's up 6.3% year over year. Total sales volume up 1.2%. And I left the numbers for from last month because their PWAR and DAR are still only reporting April's numbers. The median price in for Prince William area was 560. That's up 10.1%, and sales were up 5.8 year over year. Dulles region was 777,825, up 11.4% year over year. Total sales up 5.1%. So again, when you have these, you know, I like looking at these numbers. This is really good data to show your fence sitter buyers, right? Where, look, we know you don't like the rates, but if they can stretch a little bit and they still qualify, they getting into home ownership, the sooner the better, so that they can reap the benefits of the wealth generating appreciation of real estate, because those are some pretty significant increases in price on a year over year basis, without a doubt. Nationally, you'll hear numbers in the range of what, 4.5, 6.5, things of that nature. But I mean, those are some pretty stout numbers for the DC metro area, at least on the Virginia side where most of us are located. Lending information. Federal Home Loan Bank has a workforce housing plus program. I don't know. This came out probably they gave the banks that do it the money a couple weeks ago, 3 weeks ago. It's never enough money, right? It goes pretty quickly. I don't have a current update for our First Heritage Mortgage fund, but I know it's been getting a lot of attention and a lot of these funds have been secured. What's very unique about this is most of the Federal Home Loan Bank is for the low to moderate. Well, now this is the first time where they're actually taking and looking at household incomes that are 80.01% up to 120% of the area median income, and giving some assistance for down payment and closing costs. And it's not just for first-time home buyers, it can be repeat non-first-time buyers as well. The maximum any one household could get is $15,000, right? Borrowers do have to contribute at least $1,000. And the one difference between this workforce housing program is that there's no retention requirement. If you're doing, usually the Federal Home Loan Bank's assistance for low and moderate income, they tie them, they have requirements about staying in the home or staying in the loan for, a minimum of 5 years and of that nature. So there's no retention requirement, which is, a nice thing, because again, people that can utilize this, sometimes we have no choice, right? Maybe our jobs and our employers move us to a different part of the country. And then we're left to pay back this down payment assistance when we sell the house and move to a different area. So no retention requirement with this current workforce housing plus program. Pretty cool stuff. I had this on last month for the first time, so I left it on. There's when we go back to the low to moderate segment, Fannie Mae and Freddie Mac's Home Ready and Home Possible programs are doing a $2,500 grant. Hey, every little bit helps for the 50% area median income and below for the DS or for the DC metropolitan area. That income amount is $76,450. Yes, I know some of us are in areas where it's like, hey, that might be 50% of the area median income, but that that could be a tough stretch, because that income, in some of the areas that we're located in here in the high cost area, we know that even a salary like that doesn't go very far in terms of qualifying because of our house prices and where the interest rates are. Now, the interest rates are more favorable on the Home Ready and Home Possible, along with reduced private mortgage insurance. One little niche thing here is that the borrowers can own one other property. Okay. If you didn't we did a little webinar on how to help buyers make non-contingent offers when they are, they have a house to sell. We did a webinar on bridge loans. Most people know bridge loan of like, hey, I can get a bridge loan, cash out the equity on my current house and use it for my down payment on my next. Sometimes that's a little tricky because the borrowers in that case, they have to qualify for the bridge loan plus the loan that they're trying to get to buy the next home. But the bridge loan is getting them the equity enough to hopefully put down a larger down payment on that next house. But there's also a bridge loan where you can actually use a bridge loan short term. There's 6-month loans where you make interest only payments on them until they're paid off. But you can actually do a bridge loan and actually purchase the next home with a bridge loan. Now, that's definitely caters towards, and why I put the bullet point here is that that's for the people who have a house to sell, but they have enough liquidity and assets that they can do the purchase. And then what happens is, right, they use the bridge loan, they do a large down payment, 20-25%, they get the next home, move out of the departing residence, sell the departing residence, and then get their permanent financing in place to refinance this bridge purchase loan. And again, they'd be, refinancing and getting this bridge loan paid off before the 6-month balloon note date. So we're going to do that. I know that was the day, if you were on there, we had some technical difficulties on Cindy's end.
Yeah, I was hacked.
Yeah, I
They're
don't
bad.
correctly because of that. We weren't able to record. So what we did is we did it that day. I went through it, and we're going to offer it up again here next month. So if you weren't there for the first one, please check the schedule. I don't remember the exact date, but
It's up already at cindybishopworldwide.com to upcoming events under webinars, 11 a.m. on the 31st of July. And the agents loved it. They just loved it.
It can help some of the, it might be the catalyst to get some of those potential sellers who are just kind of, again, maybe they're fence sitting on the sell side, right? We have fence sitters all over the place, and we have house hostages, and we've got an interesting market to say the least. But yeah, bridge loan, that could be the vehicle that helps you help your next client to make that next purchase without having to sell the house first. It's not a cure-all, right? It doesn't work for everybody, but it's one of those things where being knowledgeable that it exists and having your potential sellers who are looking to make that move up by paired up with a lender who understands how it works. So that's kind of a wrap on this month's market update. Anybody have any questions, comments, concerns, anything that you're seeing out there, in the real world? Cindy and I were talking before we started. She was asking, how's business, and talked about, seeing, on the mortgage front, applications are steady. Affordability is pinched. We get people that don't have the income to qualify because of the elevated prices and high rates. And then on the other hand, some of them are credit challenged. And as I mentioned, when Cindy and I were talking, it's, if the credit challenged have time, well, that we can work on that, right? We can get them on the path to getting the scores up. The affordability piece, that's the tough one for sure. But feel free, unmute, share with us what you guys are seeing out there, or let me know if you have any questions.
Oh, cats got their tongue. So, but Mike, when we're all done though, I'm going to process this recording, and it will be on Mike's instructor page. He will let you know by sending you that email to let you know everything is up and running. And once we do the bridge loan recording again at the end of July, we'll have that on the homepage of his his instructor page as well on the site, so you can watch that in case, unless you can come, which will be really good. All right, so are we all set? Anybody have anything to say? Nope.
I hope it was good information for you. Letting you see a little bit behind the curtain on all this economic stuff that goes into this. I know it's it could be a little complex and and some of the data is contradictory to each other, but we keep plugging along. But
Well, I think this is very helpful. I really do. I love your report. All right, guys. Thanks, Mike.
all right, guys, have a great day.
You too. Bye.
Bye.